We are back. We have Joe in Hamilton. Good afternoon.
Good afternoon. I'd like to know if you think that Suncor is going to hit $50 again in this lifetime.
Great.
Okay,
well,
thanks,
that's a short and sweet question.
Yep.
Suncor is a company that we own in the portfolio. We own both Suncor and CNQ. Both are behaving extremely well. I think that really the thesis here is that the bottleneck in transportation from Canada through the U.S. is starting to break up a little bit, both by crude by rail and additional pipeline capacity. So the spreads and differentials have narrowed. I think that Suncor is a great balanced portfolio to own. It's one that pays a 2% yield. We'll see dividend growth there. Either Canadian Natural Resources or Suncor, I think, would be great core holdings in portportfolios.
There you go.
I do think you will see $50 again in your lifetime.
Okay, in your lifetime.
It's very short.
Yeah, that's a promise. You heard it here first. CNQ and Suncor up against each other. Their CNQ's been outperforming, as you see. Roman's in Pickering with the next question. Hi, Roman.
Hi, David. I have a question about precision drilling. If you can comment about the earnings numbers that came out today and if it's a good hold for the next 2 years.
Right.
Thank you.
So I think, Roman, the back half of this year is going to be an important period. From what we understand, demand for drilling services is picking up. There's a lot of companies in the U.S. that are increasing their budgets, and so we think that probably pricing firms up in the second half. So given the fact that these stocks have pulled back a little bit, not a lot, I think that it's been because there was a little bit sort of weaker activity over the last couple of months. I think that you're going to see a strong second half. I would be a buyer of these stocks headed into the fall.
There's a look at PD over the course of 5 years. The next question comes from Tony. He's in Tilsonburg. Hi, Tony.
Hello. A question for David on Agrium. His thoughts on Agrium, please.
Right. So, Tony, we as a firm have had no agricultural exposure over the last few months. You know, if you take a look at what's been happening to the price of wheat and the price of corn, it's not been a very friendly environment, getting hurt quite badly. The agricultural companies have not been performing well. Now, potash actually reported quite good numbers, better than expected, so the stock probably gets a little lift here. It's not to say this group can't get going, but seasonally you would like to see strength coming into the summer, not necessarily into the fall. And given the weak prices for grain, I'd be just a little bit cautious.
And not even an equipment player in that sector, or nothing agricultural?
We own nothing, but again, we're very targeted. I mean, I really believe, focus on the sectors people care about now. If you're in a bull market, take advantage of it. Don't buy what you hope the market may decide they're interested in later on. Over time, if you start to see change in behavior, and if you have numbers to support the view, then look at building positions. But at this point, it's just not one of those sectors. I think that if you can target in a market where correlations are falling, then it makes a big, big difference if you get to the right groups. This just isn't one of the right groups right now.
The same thing with housing with you as well.
That's right.
All right, Richard's in St. Thomas, Ontario with the next question. Hi, Richard.
Well, hi, Mark and David. I enjoy the information we get through your show.
Great, thank you.
And my question's on Citigroup. It's recovered a little bit, and I was wondering what David's opinion on it was and whether we should continue to hold it or switch to something else. Thank you very much.
Yeah, Richard, I would say that the large cap U.S. banks have been somewhat disappointing, certainly relative to other groups. Relative strength for financials hit a new low for the year just this past week. From a financial standpoint, we would prefer to focus in 3 areas: Canadian banks, asset management companies that are benefiting from the growth in assets under management and the returns they're having, and the insurance companies, which are more focused in the wealth management business, like, say, a Sun Life. The large cap banks continue to see headwinds from regulators and from politicians. Their business models have changed over the last few years. They're having a hard time getting revenue growth going. One would have thought Citigroup had a great opportunity relative to other global banks in the international markets. Market just has not seemed to care. So I think there's probably better spots to focus.
When you say asset managers, you're talking about Canadian ones primarily, or you have
Canadian one or U.S. ones? I mean, you could look at an Invesco in the U.S. They're seeing very good growth. You could look at a T. Rowe in Canada. You know, we own CI Financial. We own some of our competitors in the investment counseling business. But because if you're getting organic growth in your assets because you've got performance, and if at the same time you've had good returns and you're getting new net money coming in, that's a double-headed opportunity for growth. And if you believe you're in a secular bull market that's going to go on for a while, think about what happened to companies like McKinsey and Trimark in the 1990s. They just continued to rally. It was a great proxy for owning the market.
Right. Okay, next one is an email from Sue, and it's on DH Corp, the former Davis and Henderson. Is it a compelling buy today? Would you consider it a profitable long-term yield play, or would you sell it upon reaching a certain target in the next couple of years?
Right. So DH Corp is the old Davis and Henderson, and we look at this as a financial technology company. It used to be in the check business specifically, but today a big part of their business is financial services technology. Arguably, the U.S. banks underspent on technology over the last few years. Some would say there's as much as $100 billion worth of backlog that needs to be spent by U.S. financial services companies, and Davis and Henderson, sorry, DH is benefiting from that. So their U.S. business is growing nicely. They've had a little bit of weakness in their mortgage business, but I think that the opportunity in the U.S. probably outweighs it. So I'd buy the stock. I wouldn't put a time horizon on it. It's one that I would buy and continue to monitor the numbers, and if they continue to beat expectations in that U.S. growth business, I'd continue to stay there.
And are you in this for clients?
We own this stock.
Okay, and dividend yield here just over 4% on DH Corp. Let's take a break, and we've got some interesting looking top picks here from David, lots to sink our teeth into, and we'll get to those after this.